Hello everyone, I'm CA Neeraj V. Welcome back to my YouTube channel at the rate Accounting Buddy NB, where we simplify complex accounting topics for you. Today we will cover key journal entries that business frequently encounter. We will cover 13 topics as displayed on your screen, including journal entries for goods given on sample, loss of stock by theft or fire, capitalization entries, depreciation entries, various type of adjustment entries, and many more such business journal entries. By the end of this session, you will have a clear understanding of how to pass these journal entries correctly. These concepts are crucial whether you are preparing for exams, managing business accounts, or working in finance. So grab your notebook and pen and let's get started. Let us now learn the business scenario and journal entry when the goods are given on charity or when goods are donated. When the goods are given by the business for charity, the purchase cost of the goods so denoted is reduced from the total purchases done by the business. Donation is a business expense and purchases are reduced because the goods are not sold. Below journal entry is passed when the goods are given on donation. The two accounts getting affected are charity or donation account and purchase account. Charity or donation account is a nominal account and as per nominal account rule, debit all expenses and losses. Purchase account is credited because the goods are not sold. The entry is passed at the purchase cost of the goods. Let us now learn the business scenario when the goods are given as samples and its journal entry. Sometimes business gives samples of goods to promote sales and to reach out to new customers and new markets. Samples are given free without any consideration in return. Therefore, it is not considered as sales of the business. It is a part of the sales promotion expenses of the business. Samples are a business expense and the purchases are reduced because the goods are not sold. Below journal entry is passed when the goods are given as samples. The two accounts getting affected are sales promotion account and purchase account. Sales promotion account is a nominal account and as per nominal account rule, debit all expenses and losses. Purchase account is credited because goods are not sold and the stock is reduced. The entry is passed at the purchase cost of the goods. Let us now understand the loss of stock by theft or fire and related journal entries. In case the goods of the business are lost due to theft or fire, in both the cases it is a loss to the business and the stock in hand of the business will get reduced by the value of the goods lost. Loss of stock by theft or fire is accounted as business expense and it is debited to loss of stock by theft or fire account and purchase account is credited as it is not a sale. The two accounts which are affected are loss of stock by theft or fire account and purchase account. Loss of stock by theft or fire account is a nominal account and as per nominal account rule, debit all expenses and losses. Purchase account is credited because goods are not sold. This entry is passed at the purchase cost of the goods. In case goods lost were insured, an insurance claim is lodged for the amount of goods lost, below entry will be passed. Debit the insurance company as the amount is receivable from the insurance company and credit the earlier debit account of loss due to theft or fire account as the amount of goods lost will be recovered from the insurance company. When the full amount of insurance claim is received from the insurance company, below entry is passed. Debit bank account as the amount of claim amount received and credit the insurance company under the rule credit the giver. Now there might be a case when an insurance company does not pay the full amount of the claim. In that case below entry is passed. Debit bank account with the partial amount of claim received, Debit loss of stock by theft or fire account with the portion of the insurance claim not paid by the insurance company, and credit the insurance company as the full value of the claim lodged is settled. Let us learn business situation and related journal entries when owner of the business takes cash or goods for personal use. Cash withdrawn by the business owner or the amount paid by the business for the personal expenses of any nature are debited to the drawings account. Below is the entry which is passed. Debit drawings account and credit cash account. Drawings account is a personal account and as per personal account rule, debit the receiver. Cash is a real account and as per real account, credit what goes out. Now when goods are taken by the business owner for personal use, it is also debited to the drawings account and it is credited to the purchase account at the cost because it is not a sale. Below entry is passed. Debit drawings account and credit purchases account. Let us practice few more journal entries. Transaction T94 is on 1st January 25 an amount of $1000 is withdrawn by the business owner Mr. Toley for his personal use. The two accounts which are affected by this transaction are the drawings account and cash account. Drawings is a personal account and as per personal account rule, debit the receiver. Cash is a real account and as per real account rule, credit what goes out. Therefore, this entry is passed for $1000 by debiting drawings account and crediting cash account along with the proper narration for the entry. Transaction T95 is goods worth $2000 taken by Mr. Tooley for personal use. The two accounts affected by this transaction are drawings account and purchase account. Drawings is a personal account and as per personal account rule, debit the receiver. Purchase account is credited as the goods taken for the personal use is not a sale. Therefore, this entry is passed for $2000 by debiting the drawings account and crediting the purchase account with proper narration for the entry. Transaction T96 is business paid life insurance premium for Mr. Tooley's family amounting to $3000. The two accounts affected by this transaction are drawings account and cash account. Drawings is a personal account. As per personal account rule, debit the receiver. Cash is a real account and as per real account rule, credit what goes out. Therefore, this transaction is passed for $3000 by debiting drawings account and crediting the cash account with proper narration for the entry. Transaction 97 is unsecured goods worth $5000 destroyed by fire. The two accounts which are affected by this transaction are loss of stock by fire account and purchase account. Loss of stock by fire account is a nominal account and as per nominal account rule, debit all expenses and losses. Purchase is credited as it is not a sale. Therefore, this transaction is recorded for $5000 by debiting loss of stock by fire account and crediting purchase account with proper narration for the entry. In this transaction, since the goods were not insured, the total value of the goods destroyed is a business loss. Transaction T98 is goods worth $8000 destroyed by fire, but insurance company only paid $7000 to settle the insurance claim. This transaction will be recorded under three journal entries. Entry number 1 T98 is debit loss of stock by fire account and credit purchase account will with the full value of the goods destroyed, that is $8000, with proper narration for the entry. Second transaction T99 is passed when the business has lodged a claim with the insurance company by debiting insurance company account and crediting loss of stock by fire account for $8000 with proper narration for the entry. Third transaction number T100 is passed when the insurance company paid $7,000 to settle the claim of $8,000. Bank account is debited by $7,000 for the amount of claim received. Loss of stock by fire account is debited by $1,000 being the claim less received. Insurance company account will be credited by $8,000 being the full amount of claim lodged. Proper narration for the entry is also mentioned. Transaction T101 is goods having a sales value of $500 and costing $400 given for charity. The two accounts affected are charity account and purchase account. This transaction is recorded for $400 by debiting charity account and crediting purchase account along with the proper narration for the entry. The transaction T102 is household car sold for $20,000 and the amount is invested in the business. The two accounts affected are cash account and capital account. This transaction is recorded for $20,000 by debiting cash account and crediting capital account with proper narration for the entry. Since car sold is not the asset of the business, therefore, when sold, asset account is not credited and proceeds of the personal car sold are invested in the business, therefore, capital account is credited. Transaction T103 is business paid $2,500 as income tax. The two accounts affected by this transaction are drawings account and cash account. This transaction is recorded for $2,500 by debiting drawings account and crediting cash account with the proper narration of the entry. Let us learn the journal entries related to the sale and purchase of fixed assets. Fixed assets such as plant and machinery, furniture, land and building, etc. are purchased to increase the earning capacity of the business and they are not for resale. Below entry is passed when fixed assets is purchased by the business. Respective fixed asset account is debited with the purchase cost. If the fixed asset is purchased against immediate payment, cash or bank account is credited. While if the fixed asset is purchased on credit, supplier account is credited. Now let us learn journal entry for sale of fixed asset. Below entry is passed when the fixed asset is sold. Since fixed assets are decreasing, fixed asset account is credited with the book value of the fixed asset sold. If fixed asset is sold against immediate receipt, bank account or cash account is debited. If fixed asset is sold on credit, purchaser account is debited. If the book value of the asset is less than the sales value, the loss on sale of fixed asset is booked under the head Loss on sale of fixed assets account. It is a business expense, therefore it is debited. While if the sales value is more than the book value, the gain on sale of fixed asset is booked under the head Profit on sale of fixed asset account. It is a business income, therefore this account is credited. Either loss on sale of fixed asset account or profit on sale of fixed asset account will appear when the assets of the business are sold. Let us now learn about the accounting treatment and related journal entries for the expenditure incurred on the installation of machinery and on construction of a building. Any expenditure incurred to make the asset ready to use is a capital expenditure. Expenses such as carriage and installation charges paid for the machinery to bring it to the working condition are accounted as capital expenditure and thus they are also debited to machinery account. Similarly, expenditure incurred for the construction of the building, such as the cost of construction material like steel, cement, bricks, etc., wages paid to the construction workers are debited to the building account. Let us understand this with an illustration displayed on your screens. CCL LLC purchased bricks, cement and steel for $75,000 from BBL LLC on credit and timber for $40,000 on cash and paid $20,000 to labor contractor by check for the construction of their office building. The journal entry for this transaction will be recorded as displayed on your screens. Building account is debited by $135,000, being the sum total of the cost of bricks, cement, steel amounting to $75,000, timber cost of $40,000 and labor contractor cost of $20,000. BBL LLC will be credited with $75,000 as bricks, cement, steel is purchased on credit. Cash account is credited for $40,000 being the cash paid for timber purchase, and bank account is credited by $20,000 being the labor contractor payment made by check. In this slide, we will learn about the couple of adjustment journal entries. Adjustment entries are passed at the end of each reporting period in journal, but are particularly passed at the end of each accounting period so that the final accounts shows true and fair financial performance and financial position of the business. One of such adjustment entry is for closing stock or closing inventory. Closing stock means the unsold stock of finished goods or raw material stock at the end of the accounting period. It is valued at cost or net realizable value, whichever is less. Closing stock value is usually given as an additional information outside the trial balance. It is brought in the books of accounts to determine the correct gross profit or loss of the business. The adjustment entry for closing stock is debit closing stock account, credit trading account. By this entry, closing stock is brought to the credit side of the trading account to calculate the correct gross profit or loss of the business. Another adjustment journal entry which is passed is that of the outstanding expenses. The expenses which are incurred or related to an accounting period but are not paid till the end of the accounting period are referred to as outstanding expenses. For example, the electricity bills say for $1,500 of a business for the month of December 24 was paid in January 25. This amount will be accounted in the month of December 24 and will be shown as outstanding expense under the head current liabilities in the balance sheet as at 31st December 24. The journal entry for the transaction will be passed as shown on your screens. Debit electricity expense and credit the outstanding electricity expenses. Outstanding electricity expense is a liability of the business, and increase in liability is credited. Another adjustment entry which is passed is that of prepaid expenses, an expense which is paid in advance for the future accounting period or periods is referred to as prepaid expenses. The benefit of these expenses is realized in the following accounting year or years for which it is paid. Prepaid expenses are shown in the balance sheet under the head current assets. For example, say on 30th December 24, business paid the rent for the financial year 2025 in advance for $120,000 by check. The journal entry for this transaction will be recorded as shown on your screens. Debit prepaid rent account and credit bank account. Prepaid rent account is an asset of the business. An increase in asset is always debited. Accrued income or income earned but not received is another adjustment journal entry which is passed. Income which is earned during the accounting period but is not received or has not become due till the end of the accounting period is called the accrued income. Interest on bank fixed deposit is earned up to December 24, but it is due for payment in June 25 is an example of accrued income. It will be recorded in the financial year 2024 even though it will be received in June 25. The journal entry for accrued income transaction will be recorded as shown on your screens. Debit accrued income account, credit interest income account. Accrued income account is an asset of the business and increase in asset is always debited. Income received in advance or unearned income is another adjustment journal entry which is passed. When a business received an advance from the customer against the sale of goods or services, which is agreed to happen at a future date, is called income received in advance. For example, if a real estate company has rented a building for $12,000 per annum rent, however, they have received an amount of $36,000 being the rent amount for 3 years. In this case, the balance amount of $24,000 rent is received in advance. The tenant had paid $36,000 by check. The journal entry for the income received in advance is recorded as displayed on your screens. Bank account is debited with the full amount of $36,000 received. Rental income account is credited with $12,000 being the rent earned for year 1. Rental received in advance account is credited with $24,000 being the amount of the rent for 2 years received in advance. Unearned income is a liability of the business. An increase in liability is always credited. Depreciation is another adjustment journal entry which is passed. Due to use of fixed asset, the value of the fixed asset decreases every year. Decrease in the value of the fixed asset is called depreciation. The journal entry for depreciation is recorded as displayed on your screens. Debit depreciation account and credit the fixed assets. Adjustment entry is also passed for interest on capital. Funds invested by an owner in the business is capital. Interest is allowed on capital to determine the profit of the business. Interest on capital is an expense for the business but gain to the business owner. The journal entry for interest on capital is recorded as displayed on your screens. Debit interest on capital and credit the capital account. Interest on capital is allowed on the balance of the capital account in the beginning of the accounting period. However, if the additional capital is introduced during the accounting period, interest on such capital is allowed from the date on which the additional capital is introduced till the end of the accounting period. Let us further understand the concept of interest on capital with an illustration. Mr. Tooley has a balance of $100,000 in the capital account as on 1st of January 2024. Interest on capital allowed is say 5% per annum. Interest on capital for the accounting year 2024 will be $5,000, that is at the rate of 5% for 12 months. Let us take another example. Mr. Polly has a balance of $100,000 in his capital account as on 1st of January 2024, and on 1st of July 2024 he invested additional capital of $50,000. Interest on capital allowed is say 5% per annum. Now in this example, the interest on capital for the accounting year 2024 will be $6,250. On opening capital of $100,000, interest at the rate of 5% per annum for 12 months comes to $5,000. And on additional capital of $50,000, interest at the rate of 5% per annum for 6 months is $1,250. In case owner withdraws capital during the year, the amount withdrawn will be reduced from the capital, and accordingly the amount so withdrawn will be considered while calculating the interest on capital. Let us take a few more adjustment journal entries. Transaction T114 is interest due but not received $500. The two accounts which are affected are accrued interest account and interest income account. The entry is passed for $500 by debiting accrued interest account and crediting interest income account with proper narration for the entry. Transaction T115 is salary for $750 due to the staff. The two accounts which are affected are salary account and salary outstanding account. The entry is passed for $750 by debiting the salary account and crediting the salary outstanding account with a proper narration for the entry. Transaction T116 is out of the total rent paid for the year $1000 is related to the next accounting year. The two accounts which are affected by this transaction are rent paid in advance account and rent account. The entry is passed for $1000 by debiting the rent paid account in advance and crediting the rent account with proper narration for the entry. Transaction T117 on your screen is provide 10% depreciation on the business delivery vehicle costing $40,000. The two accounts affected by the transaction are depreciation account and asset account. Depreciation account is an expense account, and as per expense account rule, debit the expenses when they increase. Van account is an asset account, and as per asset account rule, credit asset when it decreases. Therefore, the transaction is passed for $4,000 by debiting the depreciation account and crediting the asset account of the van with proper narration for the entry. Transaction T118 is business goods costing $2,000 used to make the furniture. The sale price of the goods is $3,500. The two accounts which are affected by this transaction are furniture asset account and purchase account. Furniture is an asset account, and as per asset account rule, debit asset when it increases. Purchase account is an expense account, and as per expense account rule, credit expense account when it decreases. Therefore, the transaction is passed for $2,000 by debiting the furniture asset account and crediting the purchase account with proper narration for the entry. Transaction T119 is allowed an amount of $500 as interest on capital. The two accounts affected by this transaction are interest on capital account and capital account. Interest on capital account is an expense account, and as per expense account rule, debit expenses when it increases. The interest on capital is added to the capital account. As per capital account rule, credit capital account when it increases. Therefore, this transaction is passed for $500 by debiting interest on capital account and crediting capital account with proper narration for the entry. Let us now learn about the opening journal entry. Every business closes their books of accounts at the end of each accounting year due to the accounting period concept. In this process, nominal accounts under traditional classification of accounts or expense and income accounts under modern classification of accounts are closed by transferring them to the trading or the profit and loss account. Whereas personal and real accounts under the traditional classification of accounts, or we can say assets, liabilities and capital accounts under modern classification of accounts, are carried forward to the next accounting year. These become the opening balance of the next accounting year. The first entry in the journal book is passed to record the closing balances of the previous year, and it is called the opening journal entry. The balance sheet prepared at the end of the accounting year shows the closing balances of each of the asset and liability account. It forms the basis of opening entry. If capital is not given in the question, it is calculated by applying the accounting equation assets are equal to liabilities plus capital, or capital is equal to assets minus liabilities. Let us further understand the opening journal entry with an illustration. A specimen of a balance sheet of a business as on 31st December 2024 is displayed on your screens. Left hand side of the balance sheet is liability side. On liability side, we have sundry creditors of $24,000 and capital of $70,000, making a total of $94,000. Right hand side of the balance sheet is asset side. On the asset side, we have closing balances of cash in hand $4,000, cash at bank $15,000, sundry debtors $5,000, closing stock of $20,000, and plant and machinery of $50,000, making a total of $94,000 of the asset side. Accounts appearing on the liability side of the balance sheet have credit balance and accounts appearing on the asset side have debit balance. The opening journal entry is passed on the first day of the new accounting year, which in our illustration is 1st of January 2025. All the asset accounts are picked from the asset side of the previous year's balance sheet and are recorded to the debit side of the respective accounts as shown on your screens. Similarly, all the liability accounts are picked from the liability side of the balance sheet and are recorded to the credit side of the respective accounts as shown on your screens. Question number 74 is when interest is received, interest received account is dash. The correct word is credited. Question number 75, trade discount is dash in the books. The correct answer is not shown in the books. Question number 76, a journal is known as a book of dash entry. The correct word is original entry. Question number 77, business transactions are recorded in the order in which they dash. The correct answer is in which they occur. Question number 78, rent receivable account is a dash account. The correct answer is personal account. Question number 79, DR stands for dash and CR stands for dash. The correct words are debit and credit. Question number 80, goods taken by proprietor for personal use is debited to dash account, is debited to drawings account. Question number 81, if list price is $500, trade discount allowed is 10%, will be dash $50. Question number 82, cash discount is an dash for the seller, is an expense for the seller. In this section, we will attempt missing value questions. In question 101, the given information is total capital of $175,000 is introduced, of which $50,000 is paid by cash. Basis this information, the journal entry which will be passed for this transaction is cash account will be debited with $50,000. The balance amount of capital will be $125,000 for which bank account will be debited. The total amount of $175,000 introduced in the business will be credited to capital account. Question number 102 is goods worth $10,000 purchased for cash. For this transaction, purchase account will be debited with $10,000 and cash account will be credited. In my upcoming video of part 6 in the series of journal entries on 29th March 2025, we will cover more than 100 questions and answers under 7 categories as displayed on your screens on the topic journal. If you enjoy the content of my video and appreciate my teaching style, please subscribe, share and like my YouTube channel at the rate Accounting Buddy NB. Thank you and goodbye for now.